crypto is on the move. Prices surging to the upside, Bitcoin crossing 80K, Solana testing 100 and Sui up almost 40% on the week. And what if I told you there's a reason why this is happening, and it's something I've been saying would happen for months? In this video, I'm going to break down the hidden source of liquidity driving crypto prices higher. How long will it continue to push crypto prices higher? And what do you need to know to be prepared? If you're ready to become a more knowledgeable crypto investor, throw me a like down below. Let's jump in. Now, guys, crypto is looking very good right now. Liquidity is rising in the background. There's other forces pushing crypto higher. We're going to get to those. There's also a risk that you need to be aware of. We'll talk about that at the end of the video. But right now, I want to focus on the good news, and that is liquidity is rising. Now, I know that's kind of cliche, liquidity, but we're going to talk about exactly where it's coming from and why it started in April and is likely to continue through the second half of the year. And so this is it right here. It's called the supplementary leverage ratio. And there's been modifications to it. And what the supplementary leverage ratio is a rule. And it tells private banks how much money they need to have relative to the treasury debt that they're holding. So they want to buy $100 worth of bonds. They need to have $3, $6 of capital to match that, because they can't just have all these bonds with nothing to back it up, essentially. And so here it is. The final rule reduces the SLR standard for national banks from the current 6% standard to 3%, plus the lesser of a couple other things. It's not super important. Essentially, they're cutting this in half. And this is the main driver of liquidity right now. I want to show you a post from Steve Dons over here. Great follow. U.S. banks remain the primary source of liquidity creation, April 7th, extending loans and buying securities faster than NGDP 4 weeks into the Iran war. So have a look at this. We have loan growth up and to the right, but more importantly, securities buying up and to the right starting in April. And this is something I've been telling you about on this channel to get ready for this. So if you want to stay up to date with these developments, make sure you subscribe down below so you stay up to date. The final rule will take effect on April 1st, 2026. Guys, I've been telling you about this since the end of November of 2025. I've been telling you that this is going to be a big rule coming into effect in the beginning of April 2026. This is when it started. April 1st, the SLR got adjusted, frees up liquidity from private banks. Here we go. We have private banks starting to take off. Let me put it to you a different way. U.S. banks, securities holdings, up and to the right. Fed securities holdings down and to the right. So there's a shift happening. There's a transition. The Fed is not doing heavy QE. The private banks are doing QE, and I've been telling you about this for months. And so when you look and you see, and so this is exactly what happened. We have a 21% move in Bitcoin off the back of this SLR, which began in the beginning of April. This is the play. This is the move. And so this liquidity drives Bitcoin for the most part. I mean, we do have, again, we have this conspicuous divergence here, but I think we're beginning to catch up to that. This was because of the leverage that we saw, maybe a little bit of manipulation, Wintermute, Binance, whatever. I'm not really one to say, but you can see that we're starting to catch up to liquidity here. And I want to show you a clip from Andreas Steno over at Real Vision. He's going to break down exactly what this is, why it's so important, and what you need to know. Have a listen.
It is very related to this so-called ESLR reform, the supplementary leverage ratio reform, which basically allows banks to run more leverage without setting capital aside. What does that mean? Well, it basically means that they set aside a lot more balance sheet to low-risk transactions.
And that's exactly what they said would happen. This is from the Federal Registrar. The board expects the final rule will reduce disincentives for these banking organizations to participate in low-risk, balance sheet-intensive activities important for the functioning of the banking and financial system. And so this is freeing up liquidity from the private banks. It's not going to be the Fed doing QE. Kevin Warsh coming in said he wants to shrink the balance sheet. We'll see how well that actually goes. And so this chart right here is showing you a surge in dealer financing, essentially more treasury debt getting thrown around and more finance. Look at the last time we saw this surge was right around the time of COVID, when the Fed jammed a bunch of liquidity into the system to keep things afloat. And so this is the play, guys. I mean, this is the alpha. This is exactly what is causing this move higher, and it's going to persist throughout the year. You also have incentives for CapEx, capital expenditure, which is going to incentivize more AI build out. Whether you're a fan of AI or not, this is going to drive more liquidity, drive more economic expansion, and that is going to send financial markets higher most of the time. So this is the source of liquidity that is going to continue throughout the year. Now, what could threaten that? Because I wouldn't be doing my job if I wasn't honest with you about the threat that we have. And maybe you can guess that it's from the Strait of Hormuz. Now, how could the closure of the Strait of Hormuz affect liquidity and subsequently affect the other factors that influence asset markets? So I want to show you a quick clip from Darius. He's going to break down exactly what this risk is. This is important for you to know because it has real implications for all of us. Check it out.
What can make that not go well is if obviously the Strait of Hormuz just stays closed, then we're going to lose the modest tailwind in the liquidity cycle. And that'll obviously cause the meaningful headwind in the inflation cycle to remain a meaningful headwind. We don't expect it to remain a meaningful headwind over the medium term, but it'll stay a meaningful headwind if we're wrong on the Strait of Hormuz dynamic. And then ultimately, if you have the liquidity cycle inflecting to a headwind, inflation cycle staying a meaningful headwind, then you're going to lose the tailwind in the monetary policy cycle. And if you lose the tailwind in the monetary policy cycle and the liquidity cycle and the inflation cycle stays in a meaningful headwind, then you're going to go from neutral in the growth cycle, which is currently, we expect it to go back to a tailwind. You're actually going to go in the wrong direction to a headwind. And so that's how you can start, causing real negative outcomes in financial markets in the context of this crowded bullish positioning as indicated by the meaningful headwind in the positioning cycle. So that is the risk.
And that is the risk. And that is what you have to know. And so I want to give you both sides of the story here. Yes, we have the SLR making it easier for banks to push money into the system, driving liquidity higher. We also have the business cycle starting to turn up. Maybe I'll do a video dedicated to that. But this short-term risk in the Hormuz situation is something that you need to be aware of, something you need to be cognizant of. And regardless of how this plays out, whether for better or worse, you can be sure that I will be here to let you know exactly what's going on. And if you appreciate these updates and the content that helps you understand what it is that drives prices in and across asset markets, throw me a like and a subscribe down below. A lot of research goes into these videos. Also, leave me a comment. Let me know if you learned anything. Does rising bank liquidity make you bullish, or do you just want to see number go up? In either case, thank you for being here. See you in the next video.